Finance 101. Right, so we'll keep it as interesting as we possibly can. We'll stay on task and giving you as much information as you probably need to be dangerous, but not so much that you get yourself in trouble. So financing is one of those items that is necessary in a real estate transaction most times. Cash is becoming more and more common in the West Michigan area, or in the past. It's definitely not been a commonality. We're seeing more and more cash flow in. However, you on a regular basis will probably find that you are seeing borrowers who need to have cash. You need to kind of direct them a little bit, or at least have an idea of what product to select for that financing. So what we're going to cover today are just the four main basic pillars for financing. I'm going to give you a real 10,000 foot overview of how the thing works. I'm going to give you just the bare bones of what each of the products covers and what an advantage or disadvantage may be to each one of the different products. So we'll just jump right in at this point. Maximum loan amount, you need to know. Each of them have their own max that you can't exceed. Conventionally, that max loan amount is $726,200, so $726,200. That should cover pretty much anything you run across in the traditional West Michigan marketplace. Anything that needs a loan greater than that, you're going to definitely be in an upper category. We'll go into jumbo loans. Jumbo are their own entity. It's not a secondary market product. It's normally a private placement, and it's going to end up either at a bank or credit union. You can do that as a broker option, but $726,200. So, what's your minimum down payment on a conventional loan? Well, that kind of depends on who you are and what you are. If you are a first-time buyer, conventionally, you can put down 3%. If there are two buyers in your transaction, conventionally, one is a first-time buyer, one is not a first-time buyer, you can still do 3% down. So as long as one of the parties in the transaction is a first-time buyer, you can do 3%. Interesting note across the board here, if you owned a home, you were married, you divorced, that divorce automatically allows you to be first-time buyer again. So just something to keep in the back of your brain. If it's a primary residence and you're not a first-time buyer, you're going to have 5% down. And then if you get into investment property, it will vary depending on whether it's a single family or multi-unit. Single family, you can do 15% down. Traditionally, you can do 20%. Second home is going to require 10% down.
Hey Jeff, before we get too far,
Yeah.
Can you briefly explain what conventional FHA, VA, and RD different what those mean and everything?
Sure. So, yeah, I can explain it.
Just the Reader's Digest.
Yeah, just to give you the Reader's Digest version. Conventional means we're going to go to the secondary market. Conventional is going to be Fannie Mae or Freddie Mac. It's a loan that's sold on the secondary market. All of our products conform to their guidelines. We use their automated approval engine. It's called DU or LP, which is Desktop Underwriter or Loan Prospector, to do the approval. And a person does the final approval as far as that goes. FHA, that's Federal Housing Administration governmental loan. VA, it's of course for veterans through the VA. And then USDA is also another governmental agency. USDA, the common name for that product type is RD. You'll hear people talk about RD loans. We'll get to that, but it's a zero down. It's designed to promote primary residence within a rural environment. So if your loan, there's a way for you to verify if a loan qualifies for USDA, and it comes down to population density. So the lesser populated area is more likely to be USDA driven. It'll normally be outside of the city or in a township. So then each one of these, as we're talking to your borrower, as we get more information in, you start to either add or subtract a product type in the discussion that we're having with your borrower. So someone comes to us and says, I'm a first-time buyer, I know that I'm going to use conventional or FHA. If they want to buy in a traditional setting. If they want to buy in a rural setting, well then I add USDA to the mix. If they tell me they're a veteran, I add the VA back into that mix. Then we go into what's your credit, what's your debt to income, what are some of the seller contributions you're going to need. And as you give me answers to those questions, it will add or subtract each one of these products to what we're going to recommend. It happens internally, it's not like I'm showing them what I'm excluding or what I'm adding, but as we run through the different points of the product type, it will help you have an understanding of what I add or what I subtract and why I may or may not do that. So, secondary market, normal, government, as it comes down to who and what and where and how. Debt to income ratios. This is interesting in that the machine tells you what you can accept and what you can't accept. So when I talked about conventional has DU or LP, the automated underwriting system. Automated will come back and tell you how high you can go for your debt to income. Debt to income is your housing payment plus all your other monthly prescribed payments. We don't care about insurances. I don't care about utilities. I don't care about AFLAC. I don't care about 401k contributions. I don't care about any of that stuff. I'm looking for auto loan, a personal loan, revolving debt on credit cards, student loans, something that shows up on a credit report. And then also alimony, child support. So those are things that we're adding to your debt to income. However, if you get into a manual underwriting situation, then there are maximums that apply across the board. For conventional, normally they stop you at a 43% debt to income ratio, which would be your housing plus all of your other debt can't exceed 43% of your gross income. When we are qualifying someone for one of these 4 loans, everything's done on gross income. Oftentimes when I ask somebody, what's your monthly income, they will tell me what they bring home. Here's my net. And in their mind, that's what I should be qualifying them on. For your budget, that's absolutely true, but for your maximum approval amount, I get to use the gross before the 401k and before some of the other pieces. So we often have to go back, if they filled out the online application that maybe you shared through the app. We have a mobile app, you can share it, I can share it, anybody can share it. They come back and give me an income, I take a look, see at it, and oftentimes the first question I ask is that gross or is that net? Because it's gonna make a difference.
You said app, what's the app called?
The mobile app is called On The Go app. So whoever you choose as a lender will have a mobile app that you can share from your phone directly to your potential buyer. It's the fastest way to get our information in their hands. They can fill it out while they're sitting there with you. It maybe takes 10 minutes to complete. If they're like my parents who thumb everything. If they're like you and your age, you'll have it done in 3 minutes. Boom, 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 scroll, boom. It's not a big deal. It pops through to my phone. It'll automatically go to your phone if they list you as a partner or list you as a referral source. So you'll know, let's say you talk to someone on the phone, you hang up the phone, you send them the app, your phone will go off and you'll get a notification saying they've just installed it. Then you'll get a notification saying they just filled it out and completed it. So you know in real time and I know in real time what's happening. And then you can hold me accountable, right? You got it, what are you doing with it? What's happening from that perspective? So 43 would be the maximum on a conventional if you're doing a manual underwrite. The machine will let you go to 50. So we're always hoping for something that is an approve eligible or an accept from the machine. It measures all the risk. It's just an algorithm, just like any other algorithm, and it says whether or not you can support or not support it. PMI. PMI is private mortgage insurance. Private mortgage insurance is applied to any loan that does not have 20% down payment. It is based on your loan amount, meaning the premium is how much you pay per month. And there's a factor applied based on your credit score and your down payment. So when we talk about a conventional with PMI, I can't give you what every scenario, I could give you what every scenario is, but the board's not big enough for that category, for that chart. So just know that there will be PMI if there is less than 20% down. We're gonna add that into the payment. So then your payment's gonna be principal and interest, taxes, homeowner's insurance, and PMI.
I guess I didn't realize that if you're at 18% of down, your PMI is less than if you're at 5% down.
Only conventional.
On a
So when we
conventional.
go over to the FHA, you're gonna see that it's the exact same factor on every single loan.
Okay.
It doesn't change or modify. VA does not have them, they only do it up front. So they collect it in the upfront category. USDA is exactly the same for everybody regardless of the category. So when we get into the governmental agencies, the equity portion of it comes into play, and it's just no matter what your credit, if you qualify over the minimum credit requirements, you may have it at the same.
And I think with PMI and conventional, once you get to 20% of your loan value, then you have to ask them to take that off. Is that true of the federal ones, or does it automatically come off on those?
So conventionally, if you do nothing and you just continue to make your payments, your PMI will fall off when you hit 78% of whatever your original sales price or appraisal was, whichever's last.
Okay.
It'll automatically fall off. However, when you buy your home, and this is the beauty of real estate, it appreciates in value. Right? Once you believe that the difference between your loan balance and your value as appreciation is brought, it gives you that 20% spread. You contact whoever you're making your payment to, because loans are sold all the time, so you call the servicer. You get a hold of their escrow department or their servicing department, and you tell them that you want to talk to someone about removing your mortgage insurance. They'll make you send in a written request to remove it. They'll make you pay for an appraisal. If the appraisal comes back and shows that you have the spread, they remove it. So what could take 11 years in a natural pay down against your loan amount can be done in a year and a half if you capture the appreciation in a rising market.
Especially in the last 2 years.
Yeah, absolutely. So that's a great question. That's exactly what's going on with this piece. And it's up to you to initiate if you want it out sooner. Minimum credit scores, conventionally, 620. It's a hard stop. It's the same for every lender. It's dictated by the agencies, which are Fannie Mae and Freddie Mac. They set the minimums. There's some discussions that may change, but currently that's your minimum down payment as it relates to the product.
Are they thinking of lowering it?
See that?
Are they thinking of lowering it?
Yeah.
Oh, gosh. We didn't learn from 2008.
Well, yeah, I mean, the idea is that home ownership is being cut off for a lot of folks. If you do not have, let's say that you're my age, and you went through the crash in 2008, and you think that credit's the devil. I'm not gonna have credit, I'm never gonna have credit again, I'm just gonna pay cash for everything I do. That's not me, I wish that were me.
Oh, yeah.
But we have people I run across every day, no score, no conventional loan, you're done. That doesn't mean you have negative credit, you have no credit. We can help you build the credit, we probably have it to you in 7 months, but if you're talking to me, you want to be in a house now, you don't want to do it in 7 months, so that's a little bit of a misnomer. So they've actually changed the rules in the last year and a half, 2 years, where if you have two borrowers, one has a score and one has no score, you can look to do it. Or if you have one that has a score of less than 620 and one that's higher than 620, you can average the two, and if the average of the two is in excess of 620, you can use it.
Why don't they look at like longevity? Say you've got a renter with a score of 420, whatever, but he's paid his rent on time for 15 years.
Right.
To me, that's like a bankable guy.
Yeah. So if we were to go into FHA or VA, both of those in a manual scenario, so the machine didn't say yes, we'll look at hierarchy of credit.
Okay.
And the first thing they look at is housing. Do you have housing history? What is your housing history? Do you have lates? Do you not have lates? They do, again, they'll have minimum credit requirements, but if the machine says no, a human can say yes and override the machine. And they look exactly at that. They just do a waterfall.
Okay.
Cascade right down through the pieces.
Before you continue, when you refer to the machine, what is the machine?
So Fannie and Freddie both have their own automated underwriting system. So I input your data into the loan. I pull your credit score into my application, which is called a Corolla. And then it links into Fannie or it links into Freddie. And I hit submit, and literally all my data flows into Freddie, or it flows into Fannie, into their machine. It scans all the data that I put in, it looks at all the data sets that I put in, it draws in the credit report, turns it into zeros and ones, and analyzes the credit report and the credit score. It looks at what the anticipated value of the property will be, what's your equity position in the property, and it says you're approved or not approved. And all of that happens in about 15 seconds.
That's insane.
Yeah, it is. It really is. But so when I talk about the machine, when I talk about automated underwriting, that's all it is. It's just basically ChatGPT looking at the data that I send and says, yep, nope. And it just makes a decision based on that. We can manipulate the data, meaning I can play within it. We do it often. So when you hear me say I'm working on a pre-approval for one of your buyers, I've input the data. I've selected what I want to target. I target one of the products. I send it to the machine. The machine says yes or no. Then I go back and I look for clues within the yes or no, because it sends you findings as to why it gave you the response that it gave you. Why did it do it? Well, it may say, well, your debt to income is too high for selected product. It may say there's been late in the last 12 months in a mortgage payment. And it may say certain pieces. When you go back and manipulate that data for time frame, so you manipulate that data to lower a credit card, so the balance is lower, so the score comes up. So we can play with the data sets. That's what takes the time. It's not necessarily the underwriting machine, because that's just almost instant as it goes. Seller contributions will depend. So what is a seller contribution? You're going to make an offer. Your borrower has limited cash. Maybe they have just the minimum down payment of 3%. You can ask the seller to contribute money towards your transaction to cover costs for your buyer. Okay? Depending on how much money you put down, they limit how much you may receive. So if you are in a position where you are less than 90% loan to value, so you have less than 10% down, you're going to be limited to 3% from the seller. If you're anywhere between 25 and 10% down, 86% from the seller. So the more skin you have in the game, the more the seller may give you to cover costs. In a normal transaction right now, with the average loan size that is in our office, which is all I can speak to, our average loan size right now is about 265. 265 and a 6% contribution to the seller gives you $12,000. That's going to cover your costs all day long. $200 and some odd $1,000 house at 3%, you got $6,000. It may or may not cover all your costs. Your costs will vary. When we talk about costs, there's loan costs and there's escrow costs, there's setup costs. This time of year, the summer tax bills are due. So we're collecting 13 months of summer tax bill. The normal tax bill on that size home in our areas would be around $3,600. So out of one line item, one closing cost, right? I got $3,500, I just ate up. Well, if you got $6,000 to work with, I ate up more than half of what you're gonna use. Right? So the more you put in, or the more you put down, the more you may receive from the seller. Foreclosure wait times, this is just here for your information. As we move into the next part of the world and the economy as it exists, we're gonna start seeing this come up more and more. We'll see some more foreclosures go on. The meeting yesterday, Rob was talking about he's got 3 coming on. That's all from activity. I think he's all ready for what he's got coming back. But if you have a foreclosure, each one of these entities makes you wait a certain period of time from the end date of that event that happens in your life. Eventually, you're gonna wait 7 years before you get a loan again. It's a lucky number, right? Lucky number 7. Way to remember it. And then on bankruptcies, there's 2 types of bankruptcies. There's a Chapter 7 and there's a Chapter 13. 7 erases your debt. So you go in front of the judge, you show them your assets, you show them what you owe. They say you're never going to be able to pay that off and wipe away your debt. Chapter 7. You're going to wait after you do the 7, 4 years before you may have a conventional loan. 13 says, yep, I made some mistakes. I got a bunch of debt that I owe. I want to pay it back, so put me in a plan. We'll negotiate with my creditors. The creditors will remove or reduce how much you owe. The plan is agreed to by the court, by the judge, and signed off by the creditors, and then you enter into the Chapter 13 and you pay things back. If you are in the 13, this becomes the if then. If you're in a Chapter 13 and have got a history of payment in 13, that's good. You may petition the court to allow you to purchase a home. They will say yes or they will say no. Most say yes. While in the 13, I can finance your loan, as long as the judge said yes and I got a 12-month payment history. Okay, so there's not necessarily a huge wait time. If you finish your 13 and it is dismissed, or if you finish your 13, you've got a 2-year wait time. So you can do it while you're in it, or you got a 2-year wait time if you finish it.
So you finished it means you completed the program. Why wait 2 years? If you can be in the 13 and still get the yes.
Because.
Okay.
Fair
enough.
Because they said so we go with it.
Fair enough.
I'm not certain, I think it's because they make the assumption that because the judge and the trustee is looking at what you're doing, you should be okay. And once you leave the 13, the trustee no longer knows what's going on, no one knows what you're accumulating, and therefore
Makes
they,
sense.
you're not. I assume that's what that is, but I can't tell you that's fact.
Okay.
If you enter a 13, or you enter a 7, and it's dismissed, you gotta wait 4 years. That means you didn't complete the plan. It means you said, I can't pay, it says you're underwater, it says that you told the whole wide world you couldn't do something. You started down the road to do the plan, or you started down the road to dismiss, and then you didn't even finish that, 4 years. So these are not anything you will not remember any of that in your brain, just know the difference between the different products. We'll give you what the time frames are, but they're just interesting pieces to take a look at. So FHA, it's your maximum loan amount varies by county. So here in our world, it's $420,680. That is not a sales price, it's mortgage amount. If you're to live in a high cost area, that number goes up incrementally. We don't, so don't worry about it. Minimum down payment on an FHA loan is 3.5%, which is 1/2 of 1% higher than a conventional loan with a first time buyer. 3.5% is the minimum down regardless of whether you owned a home before or didn't own a home before. So therein lies a little bit of a difference. Here, if you were a second time buyer, you need 5%. Here, if you're a second time buyer, you still only need 3.5%. So it's the same across the board for all parties, for all people. Debt to income. This one is all machine driven, right? And I've gotten them approved as high as 55% debt to income through an automated, or through, we'll call it AUS, automated underwriting system. Manual. So the difference here is that with conventional, everything has to be, the machine has to say yes. FHA, the machine says yes. If the machine doesn't say yes, well then a human can say yes, they can override. They're gonna stop you at 50%. The manual underwriting. PMI. And if you have any questions as it relates going down, stop and ask the question. It's pretty much, I'm trying to take it across and down at the same time to keep us on track. PMI, there's 2 factors that come into an FHA loan for. Upfront, you're gonna pay 1.75% of your loan amount is added to your loan. So you're paying for some insurance upfront. When we were talking about PMI with the conventional, it's just a factor paid monthly. There's no upfront factor. There's nothing you give in advance because it's scaled. Greater down payment, higher credit score, lower amount you have to pay. Here it's the exact same across the board all the time. It is for your monthly factor, it's 0.55% of your loan amount.
That explains why closing costs on an FHA were quite a bit higher than a conventional.
It does, but remember this portion, this 1.75, it's called UFMIP, upfront mortgage insurance premium. It goes into your loan. So you will see it as a cost, but you won't pay it from your pocket. It goes back into the loan amount to finance that for you. Okay? So it definitely, when you're looking at costs and the lender sends you something, you'll see it in cost, but then it's not paid by the seller, so to speak.
Gotcha.
Credit score. Here's where the differential really begins. If you have 10% down or more, 10% down plus, I can go to a 500 credit score.
Wow.
If you have a 500 credit score, I'm almost willing to bet you a nickel that you won't have 10% down.
Yeah, it's pretty much safe bet.
Right? I mean, it's a safe bet. And then if you've got 580 plus, 580 credit score plus, now I'm back to the 3.5% down payment. So you can see as we're going down here, this product is used most often by first-time buyers. They haven't established a long-term credit score. They don't have a deep history.
Do most of these people end up in foreclosure?
No. No, they all do pretty good, actually. In fact, the one that has the least amount of foreclosure is FHA, and they're at 0 now. Statistically, they do the best. And there's a reason for that. We'll get into what that is when we get over there. But so 580 credit score, 3.5% down, FHA loan. Seller contributions on this one can be 6% across the board, no matter who you are, no matter what you put down. And again, in the world that you and I live in, 6% covers pretty much everything. Right? So that goes there. Foreclosure wait times, 2 years. Chapter 7 bankruptcy, 2 years. Chapter 13, 12 months. So, very often in 2008 through 2014, this product was used quite a bit because people went through a foreclosure. They were strong with income, they were strong with job history, they were decent with credit, but they had a foreclosure on a house because everybody had a foreclosure on a house, it seemed like. 2 years. So back into this product is where we went. Ready? All right, well, let's move on over to VA, which statistically has the least amount of foreclosure. What's the maximum loan amount you can give out of VA? $2.5 million.
No way.
Yes.
Whoa.
So it begs the question, if you're above 726, who does finance you for above those?
It's going to be a jumbo, and there's a bunch of places that we can place it. So we would sell that to a Wells, City, Chase. North Point Bank actually was big in the secondary market for a long time, selling out their jumbo product, selling out their ARM product. So you do what's called correspondent lending. It's no longer your money, it's no longer your underwriting guidelines, it's their money with their underwriting guidelines, but they let your underwriter say yes or no. So you just underwrite to their pieces, you close the loan, and at closing, the borrower is informed he's going to be at North Point Bank, you can make your payments there, and here's your coupon and your piece, and off it goes. So, but 2.5 million, so that's a lot of money to go play with and go have fun with. 0 down is your minimum down payment. So if you want to put money down, you most certainly can. A lot of folks will come back and say, I sold my house, I had a VA loan, I got 15% I can put down. I know I can't use VA, so can we look at conventional? And my answer is normally, well, keep in mind you can reuse your VA. You can use it over and over. You can reestablish your eligibility. So you can have more. You can have more than one home at one time using VA, which most people do not know. That's a process. It's not something you want to put in your brains right now, other than if someone says, I'm moving from Florida to Michigan, I got a VA loan there, I probably can't use VA here. The answer is yeah, you probably can. I can probably make that work, and I can probably do 0 down. Just depends on how much eligibility that you have as far as that goes. Debt to income ratio. So this is one that's going to be difficult to put a number to. Put a word up here instead. Residual income. In the traditional way of measuring debt to income, which is your monthly obligations against your gross income, most of these, meaning FHA being the most lenient, will let you get to 55 on an automated underwriting. VA will let you get over 60% debt to income, even damn near approaching 70. VA measures residual income, which says what's your gross income, what's left over after you pay your monthly debt, that's the residual income in your pocket. And if you meet the minimum residual income standards for Midwest, Northeast, Northwest, Southwest, and they designate it by geographic area and then family size. If you exceed those numbers, that's considered an acceptable debt to income through the residual. So it's not a number, it's what's left over. This right here is the reason it has the least amount of foreclosures, because it makes sure that you have enough money after you've paid your bills to cover your house now and then to live. So it's surprising that a 0 down would perform so well, but it performed almost perfectly. Mortgage insurance, they're going to charge you up front on your first use 2.3% of the loan amount. but they don't have a monthly factor. So you put 2.3 back into your loan amount. If it's $100,000 loan, you put $2,300 back in the loan amount. So now you have a $102,300 mortgage, right? But you have no monthly mortgage insurance premium that you're paying. Versus here and here, it's part of your payment on a monthly basis. If you're using it for the second time, they charge you 3.6% subsequent use. So if you've used your house, you purchased a home, you sold the home, you want to use it again, they're going to charge you 3.6 instead of 2.3. You can do it over and over and over again. Why would you want to pay 3.6% subsequent use? It's assumable by another veteran, so it's an assumable loan. When the world was going crazy, during COVID, when COVID first came and the shutdowns began, this rate held pretty steady for VA. This rate went through the roof. So if you were buying and you were able to be a VA loan, this thing, when it first happened, jumped up somewhere around 8%, we dropped down to 2s and 3s, right? But when it first happened, no one knew what was going on, we jumped into the 8s. That held steady in the 6s. Well, shoot, I'd take a 6% interest rate with 3.6 up front all day long versus taking 8 for a 3-year period of time. So there's some benefit that would go on with that. Minimum credit score. Pretty much same thing as here. 10% down, 500. Over 580, 0. So that works pretty much hand in glove. Seller contributions. You will hear lenders talk to you about percentages. And they will tell you that they're capped at 4%. 4% is actually about concessions, not about seller pay contributions. So I would hope that you all could put it in your brain that there's no cap to seller pays. I don't know, as long as it's not considered a concession. A seller concession is anything that is of value you are exchanging as seller to buyer. I'm going to give you a trip. That's a concession. Can't exceed 4%. I'm going to pay down some of your debt. Can't exceed 4%. So if you think about VA, just come to the conclusion that your seller contributions have no limit. Other than what market will dictate. And the market will dictate you don't go over 6. Right? I mean, the seller's just going to look at you and think you're crazy if you want more than 6. Foreclosure wait times on this thing, 2 years. And bankruptcy is 2 and 12 again. So 12 months if you're in a 13, 2 years if you're in a 7. And we move on to USDA. And this was at the bottom line, 726.2. Loan amount. Down payment on USDA, 0. You have no money that you need to put down. Your debt to income on this one. If you do the automated underwriting system, you're gonna cap out at 45. You can get a little bit higher, but it never approves. So what is allowed and what happens goes. So say at a 45 and you're burning for the automated underwriting. And if a human does it, 41%. So again, that's 41% of your total payments, housing, plus monthly obligations divided by your gross income.
Quick question on RSDA. Is the goal for those to keep it farmland, or is the goal to develop it into more housing and stuff?
So it's a little bit of both, in that they're trying to drive home ownership into rural environments, right? But if you farm the property, it's considered income producing and you can't do it. So you can have no income producing activity on a property, you can have no income producing characteristics on your property.
So they'll only give you an RD loan if you don't plan on making money with it?
Correct. Correct.
Okay, fair enough.
So if you go to buy one and you can show that the The appraiser goes out and he takes a photo, and on the photo it says, "Hey, for sale." You're gonna have a problem with that piece. Now you can come back and show, well, the hay for sale was actually for the neighbor leases the land, I don't actively farm, here's my tax returns, there's no Schedule F to prove I'm not claiming any farming income. Maybe, but, so if you're out there as an agent, you're walking a property, you think you wanna go USDA, and you see that they're selling beef, just stop. Just stop and go FHA, right? So there's that piece. Credit score on this one, 620.
But they're fine if they're farming it for private consumption.
If you are a gentleman farmer, yeah.
Okay.
Yeah, let's say you come on there's chickens running around, you got a couple of goats, I mean, that's a whole different thing. And it's become quite normal.
620's credit score.
620 is
No
credit
PMI.
score. There is, I jumped it, I don't know why. Your up front on that is 1%. 1% of your loan amount, they're gonna add that back into your loan. And then your monthly factor is 0.35. So, and again, you do not need to remember these, you don't need to have these in your head. The reason I am even talking to these, or speaking to them, is simply this: you're gonna see that if I pick a USDA, I pick an FHA, or I pick a conventional, I'm gonna have an added layered payment, right? Because it goes into your monthly contribution. If you're in a rural setting and you qualify for USDA, we're gonna pick that one all the time because it's the cheapest, at 0.35. Because that's about as cheap as a conventional gets at 17% down on an 800 credit score. It's about the same factor. You're gonna get 0.55 on the FHA, it's still better than, depending on what your credit profile looks like, it's probably gonna be better than what a conventional is gonna be. But we simply put it in there so you remember it's gonna be there. VA, there is no monthly component, therefore you can qualify for more home because you don't have a monthly factor or a monthly payment going out for mortgage insurance, so there's more money left for principal and interest. Seller contributions, 6%. So pretty much mirrors, you're probably starting to see it mirrors the FHA, VA kind of mirrors the FHA, USDA mirrors the FHA. FHA and USDA use the exact same appraisal, funny enough. So if you start with the USDA loan that's in your offer, and for whatever reason you find the property's not going to be able to USDA, you can flip to FHA or use the appraisal. Foreclosure, 3 years is your wait time for the USDA. And then unlike VA and FHA, it's 3 and 12 as it relates to bankruptcy. So 3-year wait time on the 7, 12 month on the 13. So that's a broad outline of what each one of the products dictates for what they can do and how they can do. So how does my world look when you come in to see me? I'm gonna ask you, what is your, where do you work? What do you make? Are you salary? Are you hourly? Do you work 40 hours a week? You're gonna tell me you work 40 hours a week, and you're gonna tell me that you work overtime. My first reply to you, when you tell me you work overtime, is how many hours you work. They're gonna come up with a number. 9 times out of 10, they're gonna tell me more than what they actually work. They're gonna tell me it's 10, it's really 7. I'm gonna say to them, well, have you done overtime? Have you done it for 2 years? Every year I've done it since I've been there. Well, have you been there 2 years? No, I haven't been there for 2 years. If I don't have a 2-year history of receiving overtime, I can't use it as income. So if I don't ask that next question, I don't know how long you've been there, and you tell me you have overtime you've had ever since you've been there, and I use it to qualify you, now we're all in trouble, because I use income my underwriter won't use, and FHA won't allow, and conventional won't allow, VA won't allow. So I'm asking you about your income. I'm asking you about income because I need to get to what your gross income is, because I need to figure out what your debt to income structure is going to be, right? I'm going to ask you if you know what your credit score is. I'm going to avoid trying to pull credit if they're not in a spot where they're actually shopping. If they're going out shopping, I'm going to pull credit. Credit is incredibly expensive anymore, so we avoid it if we can. I'm paying $40 just to look at their credit. So if they're thinking about it, I don't want to spend $40 on them. If they're actively going to go in the market, no problem. I'll spend the money. It's just the cost of doing business, right? if you know your credit score, and I know that it's 620 to 680, I'm gonna come back here and I'm gonna throw conventional out. Because the mortgage insurance on 680 to 620, and I'm stopping at 620 because my minimum, is gonna be so much more expensive than an FHA mortgage insurance, that it's gonna limit how much I can approve you for. So, now I'm going back to what's your gross income, what's your credit score, what product am I gonna get the best mortgage insurance for? Right?
So FHA used to have kind of like this bad taste in people's mouth
For sure.
because it was harder to buy a house that way and all that. That's changed now. What would you say to someone that says, hey, I really want to stick with conventional
As a seller or as a buyer?
as a buyer?
As a buyer, I would literally say it's entirely your decision which product you use. So let's figure out what you qualify for, let me show you what the payments are and what the rates are, and then you can make a decision based on that. I'm a big believer that math normally drives decisions, and if I show you the math and my rate's higher on a conventional, my mortgage insurance is more expensive on a conventional, and you can qualify for $25,000 less on a conventional, you'll take an FHA.
So now as a seller, why would I consider someone with an FHA loan versus a conventional?
So when you are sitting down as a seller, you are deciding with your realtor which of the products you're going to allow for offer. Is really when that discussion should be being had. You want as large a buyer pool as you can possibly get. You want to cast your net as far as you can cast. You want to open it and broadcast it to as many people as you could possibly have come see your property. The FHA of today is not like the FHA of yesterday. The repair requirements are so much more minimal now than what they used to be. Anybody that is averse to an FHA loan has either not looked at FHA in the last 15 years or had a parent who tried to do an FHA loan and they heard all of the trial and tribulations, and parents are deal killers, we all know it, right? They all talk about things that used to be, that aren't even relevant now, but we have to respect our elders. So they have this preconceived notion in their brain, well, FHA is a fine product, it's a great product, it opens it up to more people, there's more flexibility within the product, which means you can have more opportunity for offer as it exists. In today's market, not so much, because normally they're asking for concessions, or we're using FHA for a reason, right? And the seller feels like they don't have to be flexible in what they're taking. My argument to that would be, well, you need to look at the net number, not at the letter, FHA or conventional, right? An FHA letter. Don't look at that when you have the offer presented. Because if your FHA comes in $25,000 higher with less number of concessions, and they're willing to have an appraisal gap cover part of their closing costs, well, you're netting a heck of a lot more using that product. So it comes down to the agent who's presenting for the buyer and the agent who's actually done the homework up front at the listing appointment. It doesn't have to be a huge long discussion, right? When you do your listings, hey, which ones you want to allow? Normally they're going to look at you and say, I don't know, what should I do? Then your answer is, you want the broadest net we can cast, let's select it all, unless you know it's going to fail. So if you have a septic system that just had an inspection and it failed, don't go FHA, because they're going to catch it and make you replace it. Conventional, we don't care once the toilet flushes. They don't care as long as your buyer knows what they're getting, right? And that's a realtor discussion, not a financing conversation. But, so if there's things like that on your property, well then by all means don't allow for FHA remediation. So we're winnowing away, we're trying to figure out what their profile looks like. Do you have assets? Well, how much assets do you have? What's in the bank? Well, I got $6,000 in the bank. Well, I got $6,000 to work with. You want to buy a $300,000 home? I got 2%. Mm-hmm. Well, FHA has a 100% financing product. USDA, if you leave the city, is 0. I can find a way back in. I know I said it's 3.5% for FHA. There's another product and program we can do as an overlay, but that's for another training or another session. So you're trying to figure out how much money do you have, how much money can you spend, how much money can you afford, and the answer to all of those questions are all dictated by these pieces, and at the end you end up on one product. So for you as a realtor to know all of those pieces and figure out where you're supposed to go with that puzzle, God help you. Right? I mean, that's asking too much as far as it goes. What you really need to know when you walk away from one of these trainings or as you grow in the industry is in talking to that potential buyer, and they tell you they've had a bankruptcy in the past, and you say, well, how long ago? They say 2 years. You go, good, check. I can find a product that can work, right? If it's a year ago or it got dismissed, well then now we have different things we need to worry about. So maybe not, you know. If they don't have a great credit score, but you know it's 590, probably look at FHA homes so you know what you're gonna do in your search parameters for that potential buyer. Right? So the larger, the 10,000 foot view of what these products are will help you kind of select where you gotta go. And then you push it back to your lender, whoever you choose and that you wanna work with. I hope it's me, but if it's not me, which is fine, because we all naturally lean into people who are like us and motivated like us and do the work the way we do our work. If that's LMCU, if that's Mercantile, if that's whoever that person is, we'll lean into them, get your potential buyer to them as soon as you can, because they will do just what we just talked about. Winnow it down and come back to you and say, hey, here's what you gotta do. Here's how I can do my approval. Most first-time buyers are gonna end up in an FHA environment. I'm gonna tell you that they need concessions because they haven't saved $17,000. Because between down payment and closing costs, they're gonna do 15 to 17, right? They're gonna need seller concessions. I'm probably gonna use FHA because I go to 6% for the max. They're not a veteran, they're not buying outside in a rural environment. If they've owned a home before, chances are pretty good for it to get over. Questions, comments, concern?
What would be like the initial process for a new buyer? They're just gonna call you up? Are they just doing like a phone interview? Is it in person? How do you typically like to meet, greet, and interview a first-time potential?
There is no right answer to that question, in that if you will know how your borrower or your potential buyer likes to be communicated with. I'll follow whatever you tell me for communication. So often I'll get a text from the realtors that I work with, and they'll say, hey, get a hold of Bob Smith. He only texts. He works until this time. He won't respond until 5 o'clock. Let me know how it goes. Well, I text. They send along in that text, here's who I am. Here's my contact information. Here's my app, my on-the-go app, so you can download it, put it on your phone, fill it out, send it back. Tomorrow after 3 o'clock, I'll call you back and I'll tell you what I found, because I can do your pre-approval based on all the information you put in the app. So you can pull in the credit report, I can see the income that you disclose, I can see what you've got going on for assets. I do my approval, and at that point I reach out and say, hey, I got an approval, do you want me to just send it to you on text, or do you want me to make a phone call? So it's however you set the path for me to do the communication up front, because you already know how they want to be communicated with. If you're in my age, if you're 50 plus, you want a phone call, most times. Some are embracing the texting, but most times they want a phone call. If you have English as a second language, you're probably going to come to my office. And it's going to be a longer process because we're trying to communicate with one another. If you are young, you want nothing to do with seeing me. You never want to talk to me on the phone. You want everything done through that phone, and you want everything done on your laptop.
That's so irritating for my age bracket.
Mm-hmm. What's hard for you, right?
Yeah,
You gotta
because
figure out how
I
to
was
break
talking
into
to my
that.
friend the other day. He's like, well, I kind of want to start looking into buying a house. So I'm like, well, I can hook you up with a job and see what you get approved for. And he's like, I don't know if I really want to do that. I'm kind of nervous. I'm like, dude.
Yeah, I mean, we're all nervous the first time we do something, right? And now we're back to
Sure.
our feelings like we talked about earlier. That feeling's not wrong, but it's about talking about that feeling and figuring out what's the root cause of the fear. Are you afraid of being rejected? Are you afraid you're going to hear a no, or does that sound like a lot of work?
I think it's the work portion for him.
And the easiest way to get past that, from my experience doing my job, so only about my job. Someone will say, that sounds like a lot of work, and my answer is, I'm going to shoot you an app. You spend 3 minutes on it, you give me some information, you hit submit, and you're done.
Yeah, see, that's sweet. I'm going to use that.
It's really quick and easy. Now, once we're done, and you know that I say yes, and you can have money, and you're like, really? I get money? Yeah, you get money. Go shopping. Go out there and go find that house. When you find that house, I'm going to put you back to work. You know how hard that work is? You're going to go on to your banking. You're going to go bank, lmcu.com, monthly statements, PDF, submit through the app. ADP, current paycheck stub, submit through the app. ADP, W-2, 2 years, submit to the app. You're done. That's how hard it was, right? So it's only as hard or as big as we make it. And if we take it in little bites, I mean, if I made someone sit through this, like a first-time buyer seminar, oh, it's horrifying. Their eyes get this big and they never move. They never do it because it's so hard, right? Because there's so much. It's not. Get a hold of your guy, get a hold of your gal, get a hold of whoever your finance person is, ask your parents who they use, do whatever it is you need to do, but call them or reach out to them or text them. And within 10 minutes, you're going to have something in your hand. You'll complete it in 5 to 10 minutes. You have an answer by the next day and you're shopping. It's easy. It's easier than buying a car because you don't have to go a lot.
Yeah.
Right?
Right.
I like that.
And then with you guys, you just set up the profile, the stuff just falls on your phone or it just falls to your laptop. You don't have to go look at houses. I mean, they're right there.
Right.
Open it up.
Yeah.
You know you're already, in your age category, you say, I already know you're scrolling through Zillow.
Oh yeah.
Why are you wasting your time? Let me send you what's actually on the market in our area. It's still in the market. It's not just floating around out there on Zillow like it really is active. It's not active anymore.
Yeah.
It's sold, right? But you have that information. You have that data.
I like that. I'm gonna actually use that towards a pitch to our someone. We'll see how it works. I like that though. Just explain it to them a little bit
Yeah,
better.
because then you become, you're an advisor, you're not a salesperson. You're not trying to force something down their throat, you're making the ease of use just right there. It's right in front of you. All you gotta do is pick it up, right? You want generational wealth, pick it up. You wanna buy a house, pick it up. You wanna move forward in your life, pick it up. You wanna get out of your parents' house, pick it up. It's easy. It's 10 minutes, right?
Yeah.
You find the house, I mean, that's gonna be hard. It's part of winning the bid. Well, that's kind of fun. You can make that a game, right? Come on, let's go play. Let's
Sure.
go win. Here we go.
100%.
We're gonna take our lumps, man, but let's go win. Eventually, we're gonna win. So now you got the house. 30 days after you get your offer accepted, you're at a closing table. You're spending some money and you're in a house, and it's less money than if you rent. Right? And nowadays, your debt to income. I'll go to 50%. Right? On an FHA loan. So 50% of your income can go. If you go to an apartment complex and you want to qualify, you need 3 times your rent payment to get into the apartment complex. That's a 33% debt to income ratio.
Wow.
Right? So, I mean, which is easier? Buying, it's easier. First and last month's rent. Well, okay, well, how much is that? Well, let's call it $1,750 a month in a decent apartment in downtown Grand Rapids, right? You're damn near $4,000. Well, 3.5% of 100,000 is 3,500. I can give you 100% of the loan if you want 100% of the loan.
Wow.
So now you just got to cover closing costs. So I'll give you a loan amount for your down payment. You got to cover the closing costs. Oh wait, you can ask the seller to pay your closing costs for you. Really? Yeah. So you buy that house with 0 down and 0 out of pocket. You're gonna use your you're gonna give you the earnest money deposit for $500, and you're gonna pay for an inspection $500. The $500 comes back to the closing, and if the seller paid all your costs and you have 0 down, you get the $500 back. Right? So it's I'm entering your world and I don't mean to, but from my perspective, when people come to see me, that's exactly the conversation we're having.
Yeah.
We're also having a conversation, and I don't know how you guys are doing about signing the buyer's agency. For the love of God, get them to sign it, please. I tell them to get it signed. I tell them if they're incredibly cynical and they just don't trust anybody, they do just show and sells, but get it signed before you go see a house. You can't tell that buyer what that buyer needs to know if they haven't signed it. You work for the seller. And they don't get that. They have no idea. There's not even a concept that's going on in their brain. And I'm not trying to tie you into me, I'm trying to protect you from them. That's what I'm doing. Right? So if you need me to do, it's just a show and sell on this property at 123 Main Street, by all means, it's just a showing on this house at 123 Main Street. But sign it so I can talk to you. Don't handcuff me.
So stepping into our world and
Yeah.
knowing you have a foot in yours,
Mhm.
what would be what would be your top advice, and it could be multiple points, that you would give to new agents that if you did this, we're gonna get along really, really well?
You're gonna get along really well in the industry.
Yeah.
So let's use Levis just as a real quick example, right? Levis was not born in the U.S. Levis does not speak English as a first language. Levis has a full-time job. He's crushing it because he's not afraid, because he just opens his mouth and says, you should buy a house. He doesn't even think about what he's saying. He doesn't have a sales pitch. He doesn't have a marketing program.
He's just going home.
Yeah, he's just out there talking to people in his
Awesome.
community about buying a house. Telling someone that you are a realtor is not something to hide, and many do. Telling somebody that you're in sales is something you should be proud of, not hide from. People hide from being in sales. They don't know why they do. You're in sales. Sell something, right? Well, what does selling mean? Selling isn't, I can't find someone who walks to that front door and say, hey, Henry, I got this house over here, you're gonna buy this house, right? I mean, I can't make you buy the house. But it's, the resistance comes from people who know differently going to a car lot or art van. Art van is a perfect example. You could not walk into an art van furniture store without being attacked by 4 people. And they would follow you around the entire store, waiting for you to actually look, you might wanna buy something, and they would attack. Well, nobody wants that, you know, so if you gotta create that consultative ability, the consultative sale. You need to be able to jump into your elevator pitch in any given moment and not have it sound like a pitch, but something you really believe. Having a conversation with someone of your age category, and having that fear, they just don't wanna do the work. It's not work, right? So it's all those pieces where if you're confident that this is a path to wealth, if you're confident that this is the path to answering some of the questions they have about how they're gonna take care of themselves in the future, then this job becomes much simpler, because it's no longer the sales job. It's just presenting, and I'm bringing to you the solution to the problem that you have. The problem you have is housing, right? Do I rent or do I buy? Well, I mean, you and I both know it's an easy answer. They don't know it's an easy answer.
Trying to explain it to them is hard.
Yeah, I don't want to get up and shovel my driveway every day. Well, here's something I didn't know before I bought a house. Did you know that you can get a snowplow service to come to your house? They will plow it with unlimited number of pushes for $280 a season. $280.
Yep.
Right? That's not a lot of money, but in my brain, it was going to cost me thousands of dollars to have this plow service. I don't know that I'm going to have time to mow my lawn.
Lawn care service. The
Lawn
people
care
who
service.
people who do the snow plowing probably
Yeah.
won't cut your grass.
What is it? Cuts only? $25 a throw?
Yeah.
You throw up the flag when they drive by and they stop and they mow your lawn. Right? So it's not, people are afraid of the expense. It's not expensive. It's more expensive to lose what it is you're not gaining than it is to go spend that extra little bit of money. Because you're paying for it in your rent anyway. You pay for snowplow service, you pay for trash service, you pay for your water, right? I mean, you're paying for all the pieces. It's just incorporated in your monthly rent payment. Well, it's incorporated in this payment. And earn the equity of the property. You'll have people who say, well, I'm gonna wait to buy because rates are gonna fall, and they're gonna fall by 2%. Right? Well, if rates fall by 2% on a $200,000 loan, how much do you save a year? $4,000, right? You save $4,000. If you don't buy that same $200,000 and you miss out on 10% appreciation, what did you lose? $20,000, right? So you're upside down $16,000 by not buying and by waiting. I don't, if you can afford it, then why would you not do it? Now, if you can't afford it, it's a whole different discussion. You know, we're not trying to put people someplace where they're gonna fail. That's not the
100%,
idea.
and that's not what I want to do in my job.
Yeah, that's not a career builder, that's not a profession builder, that's not solving their problem, it's creating a problem. So we're not trying to do that by any means, but people miss they don't know what they don't know, and then they miss. There's a cost to waiting. Huge cost to waiting, and you don't recognize it. It's like not participating in your 401k when you're 26 years old. Oh, for the love of God, contribute for the first 5 years. You can stop it at that point, right? Because you're set.
Yeah, just builds.
But if you wait 15 years, you can't catch up to the guy who did it for 5 years when he was 26. Time value of money takes that right out of your hands. So what's my greatest advice is just talk as much as you can talk to as many people as you can talk to in a capacity that is almost contrarian to what they're saying, and not be afraid to be contrarian to what they're saying. Now's not a good time to buy. Oh, you are so wrong. Right? I mean, it's just a natural reaction to that. It's not that you're going to sell them a house. It's just, well, or it could even be, well, what leads you to that conclusion? I'm curious, what do you base that on? So again, it's not being confrontational, but now you're just exploring why do you feel it's not going to be a good time? And then you may hear something that you would go, oh, yeah, no, it's not a good time. I'm in the middle of, that's chapter 7. Yeah, no, it's not a good time. But let's get prepped for when you're out of it. Right? Fill your pipeline. Fill it for next time. Get ready for where you're going to go.
Yeah, because at most you're only out 4 years of a sale, right?
Yep.
And it could
If
be
you're
as early as
13,
12
you do it.
months.
right, you're in. So, I mean, there's plenty of ways to get down the road if you know what the real objection is, or if you know what the real fear is. And most times not buying or not going into the real estate market because of fear. There's no houses. Well, there's plenty of houses, you just gotta know how to go find them. No one's gonna accept my offer. Well, if they got a good agent, they'll probably accept your offer, especially if it's the best one. Presented in the right way. Right? Now the rates are too high. If you wait, you're gonna lose the appreciation. If you can afford the payment, take it. You know? Why hold on to $4,000 and give away 16? Your choice, right? It's just math. But it's those items that if you gotta make your fingertips and you know how you wanna respond to them, and it's not a fight, then you're normally gonna win or at least gain some attention and some traction. And then go look for the spots that other people are going to. There are plenty, as you drive through West Michigan right now, one of the single greatest things you see being built are senior living. Right? They're going up everywhere. Every community has at least 2 going up right now. They're all 3 to 4 stories, and they're all mixed use. You got single family, then condo, and they're all progressive in their nature. Right? Everybody going into one of those homes is probably selling the home to fund them going into the home.
Yeah, it's either going to the kids who are gonna sell it, or it.
Right.
Well, they're selling it.
So who then should you be talking to? It's not the kids, and it's not the mom and dad.
It's the older folks. I thought about
That's the placement
volunteering
agent.
to it.
Wow. Knock on the door, go talk to the placement agent at the home. They have a problem. They have beds to fill. You have someone who wants to come in and have a bed to fill, but they have no cash, but they have $400,000 in the house. The house is gonna get sold. That placement agent will give them your name and your number because that house has to be sold. Okay. And so it'd be those kind of things that I would be looking to do if it were me going into the real estate world. That's who I'd be talking to. People who can facilitate the answers to or solutions to a problem, that I have the solution to their problem. Path of least resistance,
Yeah.
right? So, and then work at this. This is the hardest job you're ever going to do, and no one sees it that way. Because only you motivate you, only you make you get up, only you punch your own clock, only you drive you to do something. Sue will tell you it's a matter of numbers. You gotta talk to X number of people every week, or else you're not gonna have a sale, right?
That's a lot of self-discipline.
It's a lot of self-discipline and a lot of courage. It takes courage. People don't realize how much courage this job takes. Every single day, you gotta get up and then you're gonna make that phone call. Are you really gonna make that phone call? Because that phone call is freaking scary. They might say no, right? Which is why your buyer doesn't wanna do it, because it might be hard.
He's afraid of being told no.
Right.
And I told him, like, dude, you're welding. You're not gonna get told no.
The only answer, the only way to not hear no is to ask. Because if you don't ask, it's always no. It's always no,
Very true.
right?
Good.
Cool. Well, thanks.
All right.
Appreciate it.
Thank
you.
Appreciate your time.
Thanks, Jeff.